Assalamualaikum and good morning, Doctor. Today, we are going to identify the best company for investment among 5 public listed company that we have been choose, which is all these 5 company works in different sector. First of all, we have Lotus KFM Berhad in Flour Mining, followed by Eastern and Oriental Berhad that works for property development. Also, we have QR Resources Berhad in agribusiness. Then BCB Berhad that also works for property development. And last but not least, we have 7-Eleven Malaysia for retail shop. For the business overview, we have Eastern and Oriental and also BCB Berhad that works in property development. E&O focuses on long-term project, meanwhile BCB Berhad heavy on fixed asset. Then we also have QL Resources that operates in agriculture manufacturing and is known as a consistent performer with a stable financials. Then we also choose Lotus KFM Berhad in flour manufacturing, stand out for its strong liquidity. Then, for the retail shop, we have 7-Eleven Malaysia, characterized by high turnover but also carries a heavy long debt.
We started by evaluating short-term solvency using the current ratio and quick ratio. These ratios measure a company's ability to cover its short-term liabilities. Lotus KFM stands out with very high liquidity. Both its current and quick ratios are above 6. This means the company holds more than enough assets to pay off its short-term debt. In contrast, 7-Eleven shows the lowest liquidity. Its current ratio is 0.88, while its quick ratio falls below 0.5. Although this may seem risky, it is actually quite common in the retail industry due to fast cash turnover. QL Resources and BCB demonstrate healthy liquidity. E&O, meanwhile, falls in the moderate range. From a short-term risk perspective, Lotus KFM appears to be the safest. Next, we assess long-term solvency by using the total debt ratio and the debt to equity ratio. This indicator reflects how much a company relies on borrowed funds. 7-Eleven is highly leveraged. Its debt to equity ratio exceeds 6, which indicates significant reliance on debt to funds operation. In comparison, Lotus KFM and QL Resources maintain relatively low debt levels, so this makes them financially more stable over the long term. BCB and E&O carry moderate to high levels of debt. This pattern is typical in the property development sector. Once again, QL Resources and Lotus KFM stand out due to their safer capital structures.
Now let's look at asset management using total asset turnover and fixed asset turnover ratio. This shows how well companies generate revenue from their asset. 7-Eleven performed best in this area. Its asset turnover ratio is above 2, meaning it's generating over 2 ringgit in revenue for every 1 ringgit of asset. QL Resources follow 7-Eleven closely with strong efficiency. Meanwhile, property companies like E&O and BCB have much lower turnover, which is typical due to long project cycle. Lotus KFM's low turnover reflect its smaller scale operation and market share. So in terms of operation, 7-Eleven is the most and the best efficient. Next, when we look at profitability, QL Resources clearly leads with the highest return on asset and return on equity at 0.09 and 0.15. This means they're making strong profit from both its asset and shareholder equity. 7-Eleven show decent ROE at 0.11 but has a low ROA, suggesting it's relying heavily on debt. BCB and E&O perform modestly, which common in property sector due to longer project cycle. Lotus KFM, despite having strong liquidity, has zero profitability, which is a major weakness. In summary, QL Resources is the most profitable and efficient company.
7-Eleven has the highest price earning and market to book ratios, showing strong investor interest. But this is mostly based on brand and expectation, not profits. QL Resources also scores well here, with high values that reflect both market confidence and real financial strength. E&O and BCB have lower ratios, signaling weaker investor sentiment. Lotus KFM, low price earning confirm its poor earning, though its market book ratio shows some investor belief in its equity. Overall, QL and 7-Eleven are favorites in the market, but QL's numbers are backed by solid performance. The DuPont breakdown shows that QL Resources has a balanced and sustainable return on equity, driven by healthy profit margins and efficient asset use. 7-Eleven also has good return on equity, but it is mainly due to a high equity multiplier, meaning it's heavily financed by debt. Lotus KFM performed better here than expected, but the actual profits remain low. BCB and ENO show weak DuPont return on equity, mainly due to poor asset turnover. Again, QL stands out with strong fundamentals, not just financial engineering.
First, QL Resource Berhad stands out for its strong profitability and effective management. The company has consistently delivered solid profit margins even in tough times. This shows how well they manage operations and control costs. Their leadership teams make smart decisions that keep the company growing steadily. Each business segment contributes positively, and this reflects how capable and efficient their management truly is. Second, QL maintains a low debt level with a stable financing approach. Unlike heavily leveraged companies, QL avoids over-relying on loans. This makes them more financially secure and less vulnerable during economic downturns. Their healthy balance sheet allows them to grow sustainably and invest wisely without taking on unnecessary risks. Third, QL Resource is highly efficient in how it uses its assets to generate revenue. This means they are maximizing the productivity of what they own to drive sales and profits, such as their factories, equipment, and inventory. For example, their integrated business model allows them to control multiple stages of the supply chains, from production to distribution. This not only reduces costs but increases output. Their asset turnover ratio is also a strong indicator that the company is making the most out of every ringgit invested in assets. This level of efficiency boosts profitability and shows the company is well managed at every operational level. Lastly, QL has a diversified business strategy. They operate across various sectors like marine products, livestock, palm oil, and even retail through Family Mart. This reduces risk. If one segment faces a challenge, others can support the business. It also creates multiple revenue streams and helps the company stay resilient in changing markets. To conclude, QL Resource Berhad clearly demonstrates strong financial health, asset management, efficient operation, and a well-diversified strategy. These qualities not only ensure stability but also long-term potential growth. With such a solid foundation, we strongly believe QL is a company worth recommending with confidence.